Welcome back, everyone. Today's video is going to be a bit different. I am going to talk about a stock which I own, and I'll disclose that as always, which I truly believe will be up about 100% by the end of 2021. Now, I believe this is a high quality company, and while I say I think it'll be up by 100% by the end of 2021, I think it'll at that point still be cheap. And so in this video, I'm going to tell you what the company is, what I think will happen, and why I believe it will still be cheap at that point. Now, disclosure, as always, I own this. I said that in the slide before. I did want to disclose that my cost basis is a bit lower. I bought this when there was a whole lot more up in the air. Right now, I still believe this is a great attractive risk reward. In fact, I was looking at it the other day with some dividend money to maybe add some more at this price. Now there's a bit more, you kind of, okay, know what Q2 looked like, kind of can have an idea of where we are heading forward. And the point is I still think it's very attractive risk reward today. But again, all numbers that I'm looking at, guessing at, making up here to use in this analysis are approximations. So I would recommend making your own approximations before investing because this is, as always, not investment advice. So without any further ado, I will just tell you right now that the company is Linamar. Now, I did discuss this, I think 112 days ago now or something like that in a video where I mentioned 3 cyclical stocks I'm buying, and Linamar was one of them. Now, one of the reasons I really like Linamar, and I liked it back when I spoke about it before also, but even more so now because it's proved its resilience, is that I think your risk of a permanent loss on this stock is very low. Why? Because it's really just that cheap and it's getting past any potential issues that it may have had. So obviously, there's other investments that are less volatile, less cyclical in earnings, and obviously I have no idea what's going to happen in the market, what's going to happen in the world. But I think that the price you're paying for this means that, the track that they're moving on, they're paying down debt, they're very inexpensive as is, and they proved that in the worst quarter in years, if not decades, that they still made $100 million in EBITDA. There's earnings before interest, tax, depreciation, and amortization. And so basically they had decent cash flow even in terrible times, and we didn't know this beforehand, but now we have an idea of what they were able to do. So now that I've said that I think that downside risk is much more limited than with a speculative resource equity, I'm going to explain how and why I think it will double in the next 5 or 6 quarters. So the first major reason that should make sense, I mean, should be intuitive. When things are bad, there's a lot of people taking cuts and a lot of, prices just because they need to move the inventory or no one could afford whatever. So as the globe recovers, I think that the margins in this company should start to normalize because they were very depressed in the last quarter. So, or last few quarters actually, because 2019 was an industrial recession, and then we moved straight from that into you know virus times, and it's been a rough few years, and I think that it's been a rough period has been baked into the stock price at this point. I remember when I first bought it, or sorry, before I bought it, I saw it at um, what was it, $40, 30 something bucks, mid 40s even. I thought, wow, this is ridiculously cheap. Yeah, they had a bit of debt at maybe the wrong time, but they're going to pay it off. They quality company. And then when I bought it, I just saw the price and I never do this, but I just put in market buy. I ended up paying a bit more, so it serves me right. But the price on this one was hard to believe. And I think all of that basically was because of the idea of margins being depressed. So as the margins move back to being more normal, I think the equity value should improve. So just having a look here at what the normalized cash flow is. Now this is hard to say because when things are going well, margins expand above what's normal and they make pretty good money. When things are going terrible, the margins contract and they make a lot less money. So if you look back at 2019, they were making 300 million, this is Canadian, 300 million per quarter. And if you look at 2018, when things were going better, they were making, well, closer to 350 million per quarter. But these are not great times. So in Q2, it was pretty bad. They made 90 mil, 100 mil almost per quarter, something like that. Don't remember offhand, but I'm going to assume for this analysis that the next 6 quarters, so Q3 of 20, Q4 of 20, and all of 21, the average will be 250 million per quarter. Now, I think they said recently that if things continue on the pace that they've been in the third quarter, it should look a lot like the first quarter. In the first quarter, they made, I think, just 216 million. So originally in Q3, it's probably below the 250 million, but over the next 6 quarters, that is the number I'm using. That being said, eventually I think they will surpass the 300 million, but that remains to be seen. So using the average of 250 million per quarter, that would mean that Q3 of 2020 through the end of 2021, they would make 1.5 billion Canadian dollars, which is like, I don't know, 5 US dollars or something like that. I don't know. Exchange rate. Now, let's look at the current valuation. Currently, they have a market cap of 2.72 billion Canadian dollars. They have net debt of $1.4 billion and a trailing 12 months EBITDA, that's earnings before interest, tax, depreciation, and amortization. Again, because EBITDA is just too short to say, of $750 million, meaning they have an EV, enterprise value to EBITDA. By the way, the enterprise value is market cap plus debt minus cash. So, or market cap plus net debt divided by EBITDA. So it gives them a EV to EBITDA of 5.4, which is approximately the historical standard, the historical valuation for this company. Now, I think that part of what's great here is that this is using EBITDA, including the terrible quarter that I hope we don't see again of Q2, and even Q1 was not a great quarter for, remember, parts of the world were shut down in Q1. So this is historical average valuation in a time which is not historically average. And I use EV to EBITDA, I should mention, because that's basically one of the big metrics in this type of industry, a very sometimes capital intensive industry, and where a lot of debt is used to fuel acquisitions, meaning, again, this is kind of like mining in that you have to first issue is how much money are you making to be able to pay off the debt, and in a worst case, that's EBITDA. Now, let's put the pieces together. And why, what will make this double by the end of 2021? So, end of 2021, that is, if we give it a market cap of 5.5 billion and assume that these 1.5 billion that they earned in the interim was used to essentially make the deleverage, make the net debt turn into 100 million in cash. And remember, 1.4 billion in debt, make 1.5 billion approximately, turns to approximately 100 million in cash. Then you have EBITDA of, let's call it 1 billion, because remember, 250 million per quarter, 4 quarters, 1 billion EBITDA. You give it a 5.4 times multiple, and there you have it, market cap of 5.5 billion. And the price per share of $84 Canadian compared to 41.67 as I'm speaking right now. Now, a quick note when it comes to valuations. Currently, the valuations of a lot of things are a complete mess because of hopefully one-time events that are setting things off. Now, we never know if the one-time events are going to become 2 or 15-time events, hopefully not, but it's possible. Also, valuations on certain things, on many things really, can change based on at what point in the cycle. So let's say there's a one-time event and companies are either making tons of money or not making any money, losing money, whatever. The market will sometimes see through them and assign silly or funny valuations based on those events, kind of looking past them. Now, in this case, I believe I've used 5.4 times earnings, or times EBITDA rather, for something like Linamar, and I believe that's very inexpensive and very very fair. Like I might even be a buyer then at 5.4 times EBITDA, because if you look at, like, I think there was a chart about during an acquisition in 2017 where they showed the peer valuation metrics, and this is, completely different time. The average for auto parts was 5.3 and industrials was 10 or 10.6 even. And if you were to use a blended multiple for Linamar based on where their earnings come from, well, auto parts 70% would give you 70% at 5.3 times, and the other 30% at 6.7, or sorry, at 10 times. The blended multiple would be 6.71 times EBITDA. But we're just going to say 5.4 because that's Linamar's historical average. And so I think that that's very fair. And I also believe that if you look at the track record of this company, and I'll get to that in a bit, it really could expand and the company earnings could also grow. So the other quick point here is I mentioned that insiders bought a bunch, or I wrote that insiders bought a bunch 2019 around in the 40s. They did. But the big insiders, mostly the family of the CEO, owns about a third of the company. So that is, the interests of the shareholders are very aligned with the management of the company. So their capital allocation should be very much in line with where you'd want the capital. I mean, some people just want the dividends, some people just want to buy back as many shares, and in many cases, the management is incentivized to just pump the share price higher. But when you have a CEO who's a big owner of the shares, it makes sense for them to do what's best for the long-term prospects of the company. And I think that in this case, that is very much the case. Also, in August of 2020, there were two insiders buying well off the lows, but I'm guessing they also seeing, okay, how the recovery is looking. And these weren't massive buys by insider standards. They were two people who, again, weren't the CEO, but were other directors within the company who bought about 20K each. And I mean, yes, this is not huge by any insider standards, but they paid more than 40 bucks for those purchases, and it's always nice to see insiders buying. So I did want to point out, as I mentioned a few slides ago, the track record of this company. Now, this company has grown revenues and earnings at a compound annual growth rate of about 10% over the past 15 years. Now, this metric came from a recent August, I believe, presentation where they mentioned it. 15 years, that is since 2005, and we all know what happened in 2000. I mean, so Linamar, taking you a bit back here on the company's perspective, the earnings peaked in 2007 and before, well, 2008. Then there was a down cycle, as there was for many industries, many companies, where the earnings didn't actually hit the peak again until I think it was 2011. But then within 3 or 4 years, they doubled. So my point is, this 15-year time frame includes that cycle of basically 5 years where it was a down cycle and it's hard to grow earnings in the down cycle. And then it includes the boom, and then it includes another kind of down cycle, really, if you look at what happened since 2018. So my point is this 10% euro compound annual growth rate includes two down cycles as well as an up cycle. And I think that that's a more than fair time frame. If you look at a 25-year time frame, it's even better. So, but 15 years is a fair sample size, I think. And there have been many acquisitions along the way that have helped them grow their earnings, integrate. They have done well with their allocation of capital. And my point here being, if we get into another upcycle, then I mean, all this analysis includes basically zero upcycle. It includes a partial recovery. And the other thing is they're getting to a point where, so they're a $2.7 billion Canadian company now, but as the companies get bigger and bigger, they become more resilient to volatility, to downside pressure, to cyclical changes. And I mean, and often once names get bigger, also they become bigger dividend payers. I mean, Linamar pays a dividend, but it's nothing to write home about because they've been growing their earnings at a 10% compound rate. So that's fine with me. In conclusion, I think I've said a lot here, but mainly this is pretty much a simple thesis. They just move towards margin normalization and delever a bit, and the value should go straight to the equity. This is a diversified and global company with large insider ownership, which is great. And as of today, I think this is a great, attractive IRR for and risk reward profile for my money at least. Initial rate of return is pretty good well, for me, I think that it's going to be probably up 100% by the end of next year. I think that's pretty good. And also, I do also want to mention that this is not the end. It's not like an investment that goes from now until the end of next year and then I sell out for hopefully whatever gain. No, I look at the company, and it's too soon to predict the distant future. Heck, we can't even predict next month. But it would not surprise me, not at all, if within 5 years, maybe much less, if the EBITDA of this company got to over 1.5 billion per year. And if that were the case, well, then we'd be talking about a 200% gain instead of a 100% gain. So my point is, I think this is still a very good entry point for a high quality company that has a proven track record. And if I had to put money, 2025, 2026, let's call it 5 years from now, will this be above or below? Remember, $41 today, almost 42. Will it be above or below $200 per share on a split adjusted basis? I don't know. I could easily see it because remember, if you look at the track record, if things start getting good, earnings can grow very, very quickly. And so obviously it's way too soon to predict anything like that today. Heck, it's too soon to predict a year from now, but this is just, it's not impossible, and I still think it's a very good um, entry point. But who knows? We'll see. And I will make a note in my calendar to check back on this one at the end of 2021, and we'll see how badly I mess this one up. So until then, that's what I have to say here. Well, that's all for today. As always, thank you everyone for watching, especially those of you that got this far and are hearing this. I would love to hear. I know most of you are only interested in mining stocks that are going to go up 10x next week. I'm kidding, but you know what I mean. But I'd love to hear what anyone, if anyone else here is invested in Linamar, or what are your thoughts on Linamar? Why am I right or why am I wrong? Second is probably more interesting, honestly. I love figuring out what is going to go wrong before it happens. That's much more useful. Anyway, thanks for watching. Again, until next time, have a great day.